Welcome to Legal Insights. The State Bank of Vietnam has just issued Circular 08/2026, amending Circular 22 on prudential ratios for banks. Rather than a structural overhaul, this is a highly targeted and strategic liquidity relief measure. Joining me today is our Senior Banking Counsel. How significant is this regulatory move for the market and investors?
Hello, everyone. It is a critical pressure release valve for the banking system. The central bank is sending a clear message. They are actively stepping in to ease liquidity pressures and prevent a deposit interest rate race. For the market and investors, this is highly positive. It signals a more stable interest rate environment and ensures banks have the technical room to support continuous credit growth without straining their capital costs.
Let's break down the technical changes. The new circular abolishes the previous phase-out roadmap under Circular 26 from 2022. What exactly does Circular 08 change regarding the LDR, the loan-to-deposit ratio?
As we know, the LDR is capped at 85% by the SBV. Under the previous regulation, state treasury deposits were scheduled to be gradually completely excluded from the deposit base. Circular 08 reverses this by allowing credit institutions to include 20% of the state treasury's term deposits in their total mobilized capital when calculating the LDR. Moving forward, only 80% of term deposits and 100% of non-term deposits from the treasury will be deducted from the calculation.
That sounds like a very specific technical tweak. How will this affect the backbone of Vietnam's financial system, the Big Four state-owned commercial banks?
That is the critical question and where the biggest impact lies. The Big Four, Vietcombank, BIDV, Vietnambank, and Agribank, hold around 99% of all state treasury deposits in the system. Recently, their LDRs were creeping dangerously close to the 85% ceiling due to high credit demand. By keeping 20% of these massive treasury term deposits in the LDR denominator, the Big Four instantly gain a significant technical buffer. Estimates suggest their LDRs could drop by 1.2% to 1.5%. This means they immediately unlock more room for credit growth, because they won't be forced into an aggressive race to mobilize retail deposits to meet the ratio. This directly helps in keeping lending rates stable across the broader economy.
Thank you for those insights. To our audience, regulatory tweaks like Circular 08 can have immediate and massive ripple effects on market liquidity and interest rates. Has your institution assessed how this newly unlocked credit room will impact your funding costs or investment strategies? Navigating these shifts requires a proactive approach to optimize your portfolio and seize emerging lending opportunities. Thank you for watching and see you next time.